Ladies and gentlemen, good morning, good afternoon, and good evening. We have people logging in from all across the globe. Thank you so much for joining this session hosted by Bero. My name is Shakti Prasad. I am the head of content at Bero, and I run the Procurement Espresso magazine. I welcome you all to the webinar on the topic Supplier Financial Analysis for Procurement Managers. Before I get started with the session, just a few housekeeping rules to be kept in mind. Yeah. All the participants will be on listen only mode for the entire duration of the webinar. We will take up the questions at the end of the presentation, but we would encourage our attendees to key in their questions anytime during the session. Please type them into the question box given in your control panel. It can be a question, a comment, or a personal observation. Please feel free to key them in, and I will read them out for you. There could be a lag of a few seconds in between the transition of slides, so please bear with us. If you have any difficulty in joining the webinar, if the audio is not working for some reason or the video is not showing up, please try to log back in or key in your queries in the Q&A box, and my team will try to help you. Now, I'm happy to introduce Praveen Daya, Head of Research at Bero. I hope you all can see him on your screens. Praveen worked in investment banking and corporate finance prior to joining Bero. He is a foremost finance expert. And in fact, I've personally seen him handle the Bloomberg terminal keyboard like a pianist playing a piano. You know, he's so well versed with all the functionalities of the terminal. And it's such a pleasure to really watch him handle that machine. Praveen and I collaborated on several projects. A lot many of you would have read the world's top 50 procurement organizations report that Bero releases every year. So all the financial calculations that are involved in selecting the winners for Bero Best in Class Awards is in fact done by Praveen. So coming back to the webinar, all the information presented in today's webinar is a culmination of his experience in working with large Fortune 500 companies. He'll be presenting the challenges facing procurement teams in evaluating supply finances, as well as how to practically deploy these frameworks in one's day-to-day job. Thank you so much for joining the session today, Praveen. Next slide, please.
Thanks a lot, Shakti.
Cool. Thank you, Praveen. So procurement and supplier financials. So procurement and finance are in fact, it's like a relationship that's very important. So financial proficiency is very important, I would say, for the procurement teams, because evaluating supplier financials is one of the key bedrock, I would say, in terms of working with them. In fact, the one question which keeps coming up often is, hey, I'm not an accountant. In fact, you don't need to be an accountant. In fact, Praveen used to tell me during those work-alongs that we used to have that one needn't be an accountant to do financial analysis. So they both are different areas altogether. And procurement, in fact, they need not remember every single financial ratio either. But the basic understanding of what to look for is what matters. And more importantly, better understanding of finances can also lead to better supply relationship management. We have known instances where a company, after knowing that one of their strategic suppliers is in trouble, have arranged for bridge financing. In fact, there have been instances that we know of where procurement played an active role in finding a buyer for one of their strategic suppliers when they ran into financial trouble. So knowing the finances of suppliers can really help in supply relationship management. One can have honest conversation without any inhibitions, so to speak. I think I made Praveen wait for long, so let's move on to the next slide, please. Yes, so Praveen, why don't you tell the audience as to what is the current financial landscape that is facing procurement? There's so much happened over the last 2 years. There's been the pandemic, and there's this huge financial support that's been given to small and medium enterprises, and now we are emerging out of the pandemic, and then there is this specter of inflation. So what's happening?
Perfect. So thanks a lot, Shakti, for the kind introduction, and a warm welcome to everyone. So this is a question I've been asked a lot of times by the procurement leadership. What's there for the next say 12 to 24 months, what's going to happen in next 2 years. Let me take a step back. I'll probably spend a couple of minutes on this slide just to lay the framework for what's going to happen. See, in our tracking of more than 100,000 companies, right? What we've seen is there is a jump in number of high risk suppliers out of that pool of suppliers, and this is more or less happens every 3 to 4 years. So the one which you see on the left hand side, the 18%, so this is compared to an average of say 8%, uh, 8% high risk suppliers in any supplier master. So this went down again, it came back up uh, in 2021, and this is more or less um a predictive indicator. This is a forward looking metric where you are analyzing your own suppliers and then figuring out a bunch of them who are in high risk. This does not translate to bankruptcy immediately, and there's a lag of almost 12 to 18 months between those events. If you look at the graph on the right hand side, the number of value bankruptcies which we have seen, and there's again, the same gap of 12 to 18 months is what has translated into the actual on the ground filing of say chapter 11 or bankruptcy in their respective countries. So we see there's a big correlation between your own analysis of your supplier master and what you see out there in the world, albeit with that lag of 12 to 18 months. So you are able to preempt some of it. uh, on an average, what we have seen is 10% of high risk suppliers actually end up in bankruptcy. That's a big number, right? So if you've got 8% of your suppliers, 10% of your suppliers in that bucket, you can see those large bankruptcies affecting your own supply chains going forward. Now there's a double whammy situation which the entire procurement is facing, right? So one is there were bankruptcies, but the interesting bit is it almost crashed after a while. The reason is the big COVID support measures by different governments. The monetary policy is at the losest today in the last decade, right? The interest rates which you see across the board are the lowest ever. Combined with that, the infusion of capital from the governments, 4.9 trillion is what I have just from the top 10 economies, right? And this is, if I have to compare this with, say, India's economy, which is at the entire GDP is at 2.6 trillion. US economy itself is at 20 trillion. So this is quite a high number. This has helped a lot of companies to wade over this situation, but this is not a long term capital infusion. This will end. This is going to end in next 12 to 24 months, and that is where, if I have to speak in COVID terms, the morbidities which are inherent in the financials of a company will again raise their head. So what we expect is, one, the COVID relief packages going down. The second part of double whammy is the inflation which we see in the world today, right? So this is at 4.5%. So this is the global consumer prices inflation. Historically, this has been under 3% always, and this is kind of the first time we are seeing it at 4.5. This is expected to touch 5% before it again starts to
Yeah.
come down. This creates a big pressure on the working capital of a company. The governments will not allow their own inflation to go beyond a certain limit, and that
That's right.
actually will lead to tighter monetary policies, increase in interest rates, which again is a big problem for a lot of those suppliers who are not in a healthy situation. So they'll be facing lack of support from government, from agencies, from banks. On top of that, they have to deal with higher inflation, tighter interest rates, and that's where we feel there'll be a new normal which will be set up in 12 to 24 months, where on an average from say 18% high risk suppliers, we expect it to maybe increase to 12%. If I look at the bankruptcy rates, right? So the 362 number which you see on your screen is a normalized one. So compared to an average of 100, the bankruptcies in 2020 were almost 3.6x. We expect it to stabilize around say 1.2x or 1.3x. So that's a big area of concern for procurement. So
Okay.
is everything over with the world opening up? Should I still worry about it, or there's something else which is brewing up, uh, you know uh, which might affect my way of working, my way of evaluating suppliers, who should I be evaluating? Is it the entire supplier master, or should I focus on a
Sure.
certain set to maintain my own continuity?
Sure. I
So
mean,
this
that's
is,
a
yeah,
very, sorry, that's a very elaborate explanation, Praveen. You have anything, or can we move on to the next slide? Yeah. So, Praveen, from your vantage point, you have worked with so many Fortune 500 companies. You have evaluated those supply bases. So, from your vantage point, what are some of the top challenges involved in supplier financial analysis as far as procurement is concerned? What are the typical
right.
challenges that you face, and also not so typical challenges? Of course, you have listed out a list of pointers over there. So, would you like to provide some highlights over there?
Absolutely, Shakti. So technical complexity is something which I, hear on a daily basis. What this means is, do my category managers need to understand, evaluate financial statements? Should they be equipped with this
Yeah,
kind of knowledge? If yes, then what is that they should be doing on a daily basis? Because this is not something which they're used to on a strategy side of things, right? So they have to deal with shortages, supply, demand, price escalation, supply chain issues on a daily basis. But financial is something which creates a problem only when it happens, right?
correct.
So should we train them, or there's a different way of looking at things, right? Something which we'll discuss later, the new model which is emerging.
Sure.
Private companies, emerging market companies
Yeah,
is a bit black hole, right? So information is just not available. How do we tackle that? Is there some support I can get from the market to understand what's happening there? Uh, in last, I think 3 to 4 years, a prediction of what's going to happen has taken the limelight. So I don't think procurement is happy with how things are going. They want to be in a position where they can preempt a lot of it, see this coming from a mile far, and then take actions with that knowledge. Monitoring again, so it's dynamic, right? So if you evaluated a supplier at the start of the contract and it's been years since then, a lot of things would have changed. If the report itself, the analysis itself becomes stale. The structure as an organization, right? So where should I house this knowledge? Does it require a deep function knowledge which is not existing in my structure today? Or is it okay to have some kind of a mechanism to broadcast this information across the category managers so that they can just view it and take immediate action, pick up the phone and ask that supplier, what's going on? And pivot on procurement is critical from, again, a top level view. There's a lot of information in the market, right? So you hear companies stock performance not being well. There's a lot of other information around the supplier which might be being passed on to you as meaningful information for procurement. So it's important that we are not in the business of making money from the suppliers. We are not investing in those suppliers in pretty much all the cases. So is it the same set of rules which apply to you? Maybe not. Is the going concern nature of the company more important than the EPS accretion which it's seeing in on a year-on-year basis, or the stock of the company is performing? So these are the things which I've seen being discussed a lot at the leadership level, and perhaps we can go in deeper into each of those, and as we move forward, we might be able to address some of them.
Absolutely. I mean, you raised some very important points, because I gather all of this is based on the insights and experience you have had over the period of time uh, working with some of our clients. Anyway, moving on. Next slide, please. Yes. So the Now, if you take, there are basically the four pillars of financial analysis, right? One has to look at liquidity, solvency, profitability, and efficiency, and each one has its own set of financial ratios. It may sound very simple, looking at it, and anyone who has done an MBA and gone to grad school would have actually gone through this. But then it's not as easy as it seems, especially when you practically sit and crunch numbers. Uh, so based on that, how do you think procurement should approach these four pillars of financial analysis, Praveen?
Right. So what I've seen is, procurement depends a lot on the uh, the final rating which they receive from any third party vendor or their own analysis in some cases. That
Hmm.
hides a lot of movements which have happened to lead to that rating. It sometimes also averages out what the meaning of that analysis is in some cases. So I'll pick each of those one by one. Maybe we can start with liquidity, right? uh, I'm sure everyone understand what liquidity means. It's daily operational expenses they have to meet. They have to pay their own suppliers. They have to be on top of payments which they are getting from their own clients. But how does that translate into an impact, right? So if there's a company which is not doing well on liquidity, is it a big concern? In my view, it is, because liquidity problems are the biggest reasons companies file for bankruptcy. It could be a fairly decent company, but they saw, say, a natural disaster wiped out 3 months of their revenue. That's good enough for them to take them into a liquidity problem, which in itself will translate into bankruptcy, because banks not are not going to wait for x amount of time to get their payments. In terms of benchmarks, right? So how do I compare the liquidity position of a company? So this is where their own performance usually comes into the picture, or there are certain benchmarks widely accepted which you can use. You really don't need to get a very detailed analysis done to evaluate liquidity. Something fairly simple from a benchmark perspective, but as an indicator it is delayed. What that means is companies usually try to keep up liquidity by getting funds from banks, new lines of credit opened with new banks. They want to make sure that this aspect does not suffer, because this is a big red flag, right?
Okay.
Even companies who are not doing well in some cases might be able to keep their liquidity up artificially, so hence it's a delayed indicator. And of course, interest coverage is one of the biggest covenants which banks track, right? So if it goes below a certain number, their interest rates increase, which again, becomes even more problematic for that company to pay off. Current ratio, working capital ratio. So these are the ones which typically are used by procurement, and these are like these are fair ratings, give out a lot of information, and maybe you can add a few more, but this covers the liquidity portion of any company. If I have to go to solvency, now this is more of a capital structure decision a company makes. How much debt do I need to have in a company? A lot of it could be driven by the inorganic growth. So I want to take over a company, so I'll take X amount of debt. Now the reason for that inorganic growth could be strategic or financial, right? So if it's a strategic, it ties in with your products, your product mix, your geographies which you want to cater to. There could be financial reasons also. So you take over a company which is loss making to shield a lot of your own profits. So this is where it might become a problem. It has the potential to create bankruptcy situation down the line. It's not an immediate concern. In terms of benchmarks, again, the company's own history plus the industry, right? So there's certain industry which are capital heavy. They need to continue to invest uh, on a maybe on a certain cycle to be on top of their games. Something similar to a telco company which needs to be on top of the technology from 3G to 4G to now 5G. Maybe it'll go to 6G. So they need to be ready with that capital, and a lot of it is funded through debt. Their profitability is such they're able to easily wade over those large interest payments, and that's a continuous process.
Yeah.
It's an early indicator, right? Identifier, right? So if there's a problem on solvency, sooner or later it will become an issue for that company. And debt to equity, Z score, these are the ratios which typically are used. Again, these are good enough for a solvency analysis.
Yeah.
If you're looking at innovative companies, right? So profitability is the key metric you need to be looking at. A company which is not profitable enough will not be able to invest in innovation. So this is, I think, the key indicator, or rather a selection criteria for innovative companies. uh, it's a medium impact uh, indicator. It takes a while for a company to be not be profitable enough, which eventually leads to eroding of cash and equity in that company, right? If I accumulate losses over a period of time, that directly eat into my net worth. So it's again a medium time span indicator. Industry average is the benchmark for this. There's no company benchmark. Company trends are okay, but you need to be aware of what the competitor is making. If they are at 19% and the supplier you work with is 10%, there's certainly some kind of an issue going on. Again, an early indicator, once the trend is downward, there shouldn't be some kind of conversation happening with that supplier. So all the margin ratios, whether it's gross,
Yeah.
net, EBITDA, OPEX, all of that is relevant here. Efficiency is, again, it's a delayed indicator, but important from technology and process point of view. So
Correct.
if I have a lower return on the every dollar I invest in the company, that in itself means I'm not, I haven't invested in technology for a long while. My processes are inefficient. So these typically are the cash cows of the world where they know that the entry barrier is huge. Uh, you will not have a lot of competition, hence you don't need to invest in technology a lot, processes a lot. And the ways to analyze it are to look at any kind of turnover ratio, like return on equity or return on asset. uh, if you want to convert this to a more immediate kind of assessment, then we typically look at, say, an inventory turnover ratio, which also is all about efficiency, how
Yeah.
quickly and easily you are able to turn the investment you have in that inventory. So
Okay,
these
that's
are
great.
the the four pillars. Yeah, yeah.
Yeah, that's great. I mean, that's I mean, I think you managed to pack so much information as far as what all the ratios that can be looked at is concerned, Praveen. That's great. I think there's some issue with the back end. Can we move to the next slide? Are you able to move the slides? Okay, but okay, that's good. Cool. Okay, so Praveen, you presented the framework, you gave the concept. I think the main question is, how do say okay, I'm not a finance practitioner. If I'm not a financial practitioner, and how do I still go ahead and use some of the things that you have mentioned, especially for practically if I want to evaluate a supplier, how do I make use of all that?
Great question, Shakti. So to make it easier for everyone, perhaps I'll paste this in an Excel sheet neatly and send it across to all participants, right? So that will
Okay,
make it
that's
easier for later reference. So,
indeed.
you know, yeah, so that's a process which every company follows, right? So they have their sources of information. You might have access to Bloomberg, Factiva, Financial Times. Annual reports, of course, are available for all public companies. There's buried information in some of those countries where they track for tax purposes and all. The next step is pretty much to put that all of that information for a particular supplier in one place, calculate all of these ratios.
Hmm.
uh, there's a big chance that you might not be able to compare a facilities management company with, say, a consulting firm, or a manufacturing company, or a different category company altogether. So this is where the benchmarks come into the picture, right?
Yeah.
So there are certain uh, way in which every industry is structured, the kind of debt which they carry, the profitability they have, the growth opportunity that particular category or industry has. So hence, it's important to see or evaluate all of these ratios, all this information in the light of where that industry is or how that industry operates. So that is where the benchmarks are different by industry, by category. And once you have that comparison available, then it becomes much easier to identify a high risk company which is notified by HR here. If the margins of a company are less than the universal average, then it becomes a high risk situation. So if you go through this entire list, some of these ratings you might not have come across typically in the financial analysis side of it, which is not done or focused on procurement. So things like self-sufficiency ratio,
Hmm.
these are created or devised just to make sure that we are talking about the going concern nature of the company and not looking at profitability or the ability to repay some of the debt which credit and the Wall Street looks at. So this
Yeah.
comparison then becomes important to, again, there is certain rather risk appetite for each of our clients. So in some cases our clients feel, okay, solvency is the biggest thing I worry about. I can maybe infuse some capital to support liquidity, the reference which you were giving, one of
Yeah.
the clients we saw supporting their own
Yeah.
supplier. So they might not be too worried about liquidity but they are worried about solvency. The capital structure has to be in this. Or if
Correct.
they if it's a focus on innovation, then the profitability has to be there. If it drops below a certain level, then they start thinking, they're not making enough money to invest X amount in capex, maybe for expansion or maintenance or for innovation next year, right? So the weighting of all of these ratios, these buckets of analysis, liquidity, solvency, it it sometimes varies with client and their own risk appetite and their own ability to operate in that kind of framework. So after you have those weightages uh,
Hmm.
applied to the entire framework, the overall financial risk rating is something which gives out a lot of meaningful information.
Okay.
The big difference between uh, the category manager's ability to absorb all of this versus, say, a set process to make this all presentable, right from, excuse me, collection of data to the analysis and then that rating. I think that's where a lot of procurement firms vary, and there's a trend which is emerging, where there's a set process for the category manager to come every day, see what's happening, and then if everything is fine, maybe they'll not find it impactful enough or risky enough for that particular set of suppliers for the entire year. That's absolutely fine. But if you don't have that system and something goes wrong, that's where a lot of these problems arise. Time to information is impacted because you hear it from your supplier when he is in a situation where he can't, or he may not be able to hide that information any longer. So that's where it's important to boil everything down to a single number which can be easily tracked by the entire community, not just the set of people who understand finance very well.
Okay, that's interesting. So this overall financial risk rating, the final number, that comes out, it's basically for a single supplier, right? So
That's
all
correct.
this analysis, so you do it for a single supplier, and then you aggregate it for all the, so whatever supply base you have, you want to run these numbers on, and then you aggregate it.
Absolutely. And this aggregation is a co-development between, say, somebody who's working on the financials of a company and the company's own view on how risk should be interpreted, what is the risk appetite which each of those companies have.
Okay, okay. So I think there's another area where procurement and finance can actually collaborate. I think Giuliano Damas Damasceno, I hope I pronounced the name correctly. Uh, she asked a very pertinent question to this slide. That's why I posed this question, Praveen. So, what is UAHR and LR? Mentioned on the slides.
So this is the comparison with the benchmark. So UA is the universal average. So it could be for the entire set of all industries, or it could be for a particular industry, right? So UA stands for universal average for, say, a set of ratios. So gross profit margin universal average is 6%, but the
Hmm,
supplier is at 3%. Then that
hmm.
becomes high risk, which is HR, and LR is low risk if they're doing better than the universal average.
Yeah. So, universal average is basically the benchmarks, and the benchmarks
It is.
either they can calculate it in house or get it from outside, right? From third party.
Absolutely, yeah. So
Yeah.
in-house, based on what you've seen historically with your own suppliers, or
Yes.
these benchmarks are available, and it has to be at the industry level,
Yeah.
to make it
That's
more
important.
meaningful.
Yeah, that's important because you have mentioned gigs based sector benchmarks, because uh, you can't compare apples to oranges, right? Because what is perceived high risk in sector A need not be high risk in some other sector, because some sectors are prone to spending more and more money, especially innovation based companies, for example. And then you look at that, and then you can't really compare it with a traditional sector. So I believe
Yeah,
those
absolutely.
differences also comes into play before evaluating. I believe that's where the universal average comes into play, right? The benchmarks, so that you don't paint everyone with the same brush.
Exactly. And a stark example which I've come across is the negative working capital I've seen for companies, right? So
Hmm.
there are companies who get revenue before they deliver the services. So that revenue itself becomes a liability till the time you can't recognize that as revenue. So it sits as a liability. And when you subtract the liabilities from the asset, liabilities are way higher than, uh, the assets. So that
Got it.
might look, uh, you know, it from the financial point of view, it will come up really bad. But then you have to clean it, the numbers up a bit, remove the unearned revenue from the liabilities, and then look at that company from a pure financial point of view.
Okay, that's interesting. I think moving on. In fact, I think one of the pertinent question is, should uh, procurement do all of this? We'll come to that, on their own. I mean, okay. So this is again a very interesting point, Praveen. How to decode finances of private suppliers, because not all the companies are listed in the market. Not all of them are obligated to report their numbers, file it with the regulators, file their audited reports with the regulators. So decoding this finances of private suppliers is again a major challenge that you are faced, especially working with clients. So what are your observations on this subject?
Yeah. So number one observation, 80 to 85% of suppliers in any supplier master will be private, right? So
Okay.
that can be taken for granted. And the information availability, as we spoke about earlier, is pretty low, right? So
Okay.
there needs to be an approach which addresses the key suppliers in the ecosystem, in your own supplier master, in your supply chain. The approach is three-pronged, right? uh, what we have seen is around 30 to 40% of these suppliers, and these need to be high spend suppliers, right? You
Hmm.
should not apply this to maybe a tail spend supplier. It's not
Yeah.
required because there'll
Hmm.
be a lot of redundancy in the market where you can find another supplier pretty quickly. The red flags, the top ones, right? So we monitor these companies on almost 30 parameters, and the
Hmm.
top five ones are listed here. So management change is the biggest indicator. If the CEO has been changed twice in even 2 years, that's a big red flag. Or
Hmm.
CFO and COO together, they left the company. Again, a big red flag, right? So a lot of internal problems might surface, through these kind of changes in an organization.
Yeah.
Ownership
So these are
structure,
proxies. Sorry. So these
yeah,
are like proxies for the actual hard numbers that you could get
yeah, yeah.
to figure out if someone is in trouble or not. Sorry. Go on. Yeah.
Exactly. So this will start reflecting in the financials of the company, even if they don't disclose. So you'll see some kind of bailout happening from a parent company or from some other agency, a big loan, something to support them.
Sure. Sure.
Ownership change is the overall structure of the firm, right? There's a big PE which has suddenly sold its stake, but not to a strategic buyer who's in the industry. It's been sold to some other PE which does not even focus on that particular sector. So that's a big red flag because I think the PE might have they don't think that the company is going to give them the same level of results, and the strategic buyers which are there in the market, they don't think the company is going to perform at the same level, or they have the fundamentals to survive for the long term in the market. Layoffs, again, big indicator, and this goes deeper than the company level layoff. This should be looked in reference to the business unit you are working with, right? So every company might have say 2 to say 10 business units which they manage, and uh, you are procuring from one of them, and if that business unit uh, is seeing any kind of layoff, that's a red flag because the company might still survive. The financials might still look good, but they can look to hive that company off to a competitor or to another supplier in the same industry. So it creates some kind of a problem. Litigations, again, you'll come across hundreds of litigations on companies, but the meaningful ones are the ones where the supplier or that company is provisioning for. So it could be a
Hmm.
big number, in some cases 2% of revenues, and by law they have to provision a lot of it in the financials. So I have to charge that as an expense if I expect a probability that it will not go in my favor and I'll see it some impact. So that's something which is critical. Sanctions and PEPs have become non-negotiable, especially with
Hmm.
in the post-COVID world where a lot of governments have helped each other or not helped each other. So that starts to starts to reflect in the scrutiny which these companies are getting from different countries. So a client in US will look at a company in China very differently versus say in India or Poland where the procurement could be happening. So sanctions and PEPs are being used as these tools to make sure that you're aware what's happening in which part of the world a big conglomerate is facing a
Sure.
sanction in one country out of the 20 they operate in, right? So this is something which is coming up really quickly as we move forward. Next is the databases, right? So even though financials are not available, but there's a lot of banking history for any
Hmm.
company which is available with these third parties. So payment data, how they're paying to their own suppliers, has the number of payment or the value of payment gone down in say last 6 months. For a lot of companies, even though they are private, there's a credit debt component to it, right? So this is what the credit agencies use to give that credit rating. There are regulatory filings which a lot of these companies have to do with their own governments, and this might not be for financial evaluation purpose, but this is more from a tax point of view, right? So these are databases which are free in some countries, it could be paid in some countries, which is again it's a treasure trove of pretty much every company operating in that country. And risk ratings again, right? So a lot of this data is put together by a lot of agencies who make sense of how the company is going to operate in next 12 to 18 months, and they come up with their own rating. So again, almost 25-30 parameters go into creating that rating. But the best part is they're able to cover not that you know 15% of your supply master. They pretty much reach 95% of supply master as an aggregate. So there could be a provider who's strong in one geography, there's another one who's strong in another one. So if you combine all of that together, in my view, you should be able to reach that 95%. And this is something which is a fairly asset light, right? So you don't have to put in create a big team to get these ratings. So it should be done for pretty much the entire supplier base where you feel any kind of impact can be a problem. The last is direct scrutiny. We've not seen more than 15 to 25% of success in this. This is a direct approach to the supplier to share financials. In some cases, those financials might not be audited. So do you even believe those numbers? If it's audited, then the number goes down, right? The number of suppliers will be sharing this information.
Sure, sure.
But this is a mandatory step for strategic suppliers, right? So if the supplier is involved in your process, which will break down if they're not there. If they're customer facing kind of a company where your customers interact with that supplier, so for them it's kind of a mandatory step along with say the contracting stage and keeping it updated on a continuous basis.
That's cool. So this three-pronged approach, I think you laid it out quite well, Praveen. We will revisit this again, I know maybe during the Q&A. Can we move on? Next slide, please. Yes. So monitoring again, prediction and monitoring, like you said, that's kind of the evolving mechanism, especially in this uncertain times when pandemic came out of nowhere. So predictability assumes significance. So briefly, Praveen, what? So based on your interactions and reading of the market, so why this is so important and what kind of elements that go into this predicting and monitoring mechanism?
Right. So a lot of financial information is backward looking, right? It
Hmm.
helps in predicting the gap of 12 months, which we spoke about earlier, between a high risk company and translating into a bankruptcy. That's static in nature. It's something which has affected the company. It has been drilled down into their numbers, and it can be seen in their financial statements. Uh,
Sure.
a lot of changes in this financial position of the company are driven by external events. So we look at operational events, legal, socio-ethical events, business risk, which of the location where the company is operating from. So when you have a mechanism to tie all of this together, right, through an automated, curated, continuous system, right? What I mean by that is it's nearly impossible to do any of this manually.
Sure.
Even if
Absolutely.
yeah, and even if you've got an automated system, the number of things you'll need to monitor is again unmanageable. if you don't curate it. So just to give you an example, we cover around 8,000 odd suppliers for one of our clients. The number of alerts which we get as a company on that set is around maybe 200 to 300 on a daily basis.
Oh wow.
The
Okay.
number of the risk alerts which are being sent out to client is not more than five. Five is a big number. Maybe two to five on a daily basis across those 8,000.
So
So
your
there's a
your team
level of
curates it.
curation.
Yeah, curation.
Yeah. So
Yeah, that's cool.
yeah, yeah, that's absolutely important. Otherwise, it'll get buried in the noise. Anything which has changed in the ecosystem, and of course, it's a daily thing. You have to be on top of it. You can't, you know, rely on analysis which is done today, and it'll not be applicable maybe even 3 months down the line in some cases.
Obviously, of course, of course. That's great. So next slide, please. Next slide, please. Yeah. So the emerging model to manage supplier risk. So Praveen, so this is what you have seen in the market, and which is widely adopted. Uh, so why don't you explain how some of the major companies are actually handling this supplier risk based on your interactions and understanding, and maybe some learnings that you can share with the audience.
Right. So different, companies are in different stages of addressing the financial risk problem for their own suppliers, trying to gauge what's happening in the market. But two things come, or rather stand out, you know, from any conversation we have with the procurement leadership. One is agility. So this is the time to information, right? So if something
Yeah,
happens, do I know it today, or do I come to know of it when I don't have many options left? Second is asset light. Do I boil the ocean and do go in depth into each supplier? Is it even required, right? So asset light, where you screen the supplier master and then take decision based on what comes out from there, and then go maybe deeper into some of those very focused areas where it's a strategic supplier where they're not doing well. What can I do to support them, or do I really need to find an alternative? So procurement COE is something which is an emerging trend, right? So we saw this was the case with maybe 5 to 10% of the companies we've interacted with back in say 2016, but now it's a case with maybe even 25 to 30% of the same set of companies. So
hmm,
there's focus. Financial risk is a part of it, right? So this is managed entirely by this team. So there's no need for every category manager to really be an expert on this, but they high level understand, what's happening, and this is the rating which I can drill down into. So
yeah,
rating is not doing well. So these are the reasons why it's not doing well, so that the category manager can have that open, candid conversation with the supplier. Maybe they have some information which the market might not be aware of, right? And that justifies an improvement going forward. Pivot on procurement, again, the analysis has to be the it has to be focused on what procurement wants.
sure,
Again, this is a criteria for the COE to co-develop with somebody, right? And then agree on those uh, internal risk appetite
sure, sure.
parameters.
Yeah, yeah,
Internal alignment, again, so this is how this team aligns with the category manager. Is there a internal tool which broadcasts this information? What is the mechanism to monitor and let the category manager know if something changes? And value at risk is again a responsibility of the COE, where they track it for the entire company, right? So there's always a, a probability attached to each rating, right? So if the rating is five is high risk. High risk means 10% of your suppliers might go into bankruptcy. You take the value of procurement from those high risk companies, you multiply it with 10%, and same you do for all the companies for medium risk, low risk. Again, the probability will go down. For medium, from 10 it'll go to 5, even 3. For low risk, it could be even be 0.1%. So that number gives you a view on how you're trending on a Q on Q basis, and it gives
sure.
you enough data to share with anyone, even the board likes to have this information available in what I've heard from a lot of CPOs. So a very good number to track and be on top of. And a lot of information required to run the COE might be external. So there's an internal part to it. Have those connects with those sources of information so that everything is in front of your eyes. You're getting the alerts. You have that information coming in. It's getting refreshed on a continuous basis. And digital delivery is again non-negotiable. It's almost impossible to manage this kind of data and deliver it to your own organization. So there's some kind of mechanism, tool, internally developed or external, which is being used by all procurement organizations to broadcast this information.
Okay, that's great. So we've been getting some messages as to how to practically apply and evaluate their supply base. So I think let's run a poll, just to gauge the interest. I want to see basically how many are really interested. Mirza, can we run the poll, please? Can we bring up the poll? Yes. So dear audience, this is a quick poll just to gauge the interest. Would you be interested in supplier risk diagnostic session for your organization? You can either say yes or you can say no. It's entirely up to you. So please let us know if you would be interested in a supplier risk diagnostic session for an organization. This basically, we will be applying some of the methodologies that Praveen had discussed here. So Praveen, while people are answering the poll, perhaps we can take a question. So this is from David Nichols, Praveen. The question is it better to have a specialist coordinator that feeds this all into category managers? Uh, I think this is basically is somewhat relevant, related to the procurement, rather the risk COE that you had mentioned now. Am I right? Or is there anything else that you would like to add?
No, absolutely. It's always beneficial to have a specialist which understands, sets the process right, and then it goes into the bucket of the category manager. The good news here is once you're through with that process, right? So you understand your own risk appetite. You've brought in certain elements of criticality related to the supplier. So criticality rating is something which the category managers might be feeding in. And then there's a
Mhm.
external or your own evaluation of the health of the supplier. You mix both of those together and then come up with a rating which makes sense for everyone, right? Once you're through with this kind of assessment, maybe it'll take 3 months, 4 months. The the requirement to have that financial expert within the team goes down because it's
Okay.
kind of a one-time activity. It might need a refresh in 2 years, but it's not a continuous support which is required. But it's always beneficial to have core financial knowledge within the COE for that period of time till it stabilizes and everybody understands the ratings, how to drill down. They might have a lot of questions, so it's always beneficial to have a certain person.
Okay, sure. I think this poll is kind of blocking the screen. Have we received responses? Or people have voted? If yes, maybe we can remove the poll. Okay, so okay, yeah, that's great. Cool, thank you, Miza. So next question is from James Moran. So for private suppliers, can you outline the most likely source of data for tailspin suppliers? I think tailspin private suppliers, James is looking for the most likely source of data. Any top of the mind you have,
Absolutely.
Praveen? Yeah. Hmm.
So out of the three buckets, it will be the second bucket, right? So it has to
Okay,
come from the credit rating agencies or the third party ratings, which a lot of vendors are available. I'll not name them here, but
sure,
I'm sure
sure.
procurement has worked with a lot of them in the past. And in my view, one rating agency might not be able to solve your tail spend problem, right? It
Hmm.
could be the diversity of suppliers we have in terms of geography is different, and the ability of these vendors to address a particular geography is also different, right? So in my experience, if you talk about, say, the Australia New Zealand region, there's only one company which can actually give you any meaningful ratings, right? So
Hmm.
that changes with the region. APAC has another set of rating provider. Europe, there's one strong and maybe three not so strong. US is covered entirely by another vendor. So it has to be a mix of different agencies where you can get information on your tail end suppliers. And in my experience, you'll still be able to cover maybe 90-95% of it if you have access to all of those. If you have access to one, maybe it's more in the 50% range, and the incremental benefit of having another one then keeps on increasing the overall coverage you will have in your tailspin and suppliers.
Okay, I think we have a very interesting question from Valentina Malone. Do you think it is important also to take into account during an analysis a benchmark calculated for different kind of raw materials with which the company work with? That's interesting. Do you take that into account, Praveen?
Yeah, that's a great question actually. And since raw material is way down the overall structure, right? So if I start with a GICS, Global Industry Classification System, and each of these companies are dedicated for a certain industry, right? But they might have a different business unit. So 60% of a company's revenue can come from, say, polypropylene, but they
Hmm.
also do five other different commodities. So what we do is we look out for a proxy company which has maximum amount of their revenue in that particular commodity, right? So I look out for a polypropylene company where kind of 90% of say their revenues come from the same commodity. So that gives you a better benchmark of comparing a supplier versus say a chemicals company which will be GICS classification. So benchmarks are important. It can be very specific in some cases. You can benchmark that company only with five others who are in that space. It gets diluted as you move to that sector definition, and for critical ones, there is a need to go down to those benchmarks where your entire production depends on, say, that set of suppliers.
That's cool. So there's a question from Pamela Dawson. I think. So are you going to walk through an example of financial reports? Something like Dun and Bradstreet report. So we're not going to do that now, Pamela. So perhaps one of us will reach out to you. Maybe we can set up some time to walk through the report. Team, please make a note of this request from Pamela. So next question. This is from. This is from James Morris. Is access to country regulatory filings free of charge or only accessible via a subscription? That is it behind a payment gateway? That's what he wants to know.
Uh, if it's available for free, it's not behind a payment gateway or even registration in a lot of cases. But there
Okay.
are examples where it's behind that payment gateway. In these systems which some of these governments use are also archaic, so it's not easy to go to that XBRL type of format, get information. So I'll take an example of India where the MCA, the Ministry of Corporate Affairs, has financials on pretty much every company which is there in India. But it's a nominal charge, less than $1 to get to those financials. And their systems are also not the most advanced where you can download it, in whatever format you want. But yeah, it's in maybe 50% of cases, it does not require any payment. It does not require any registration.
Okay. So the next one is from it's to do with Altman Z score. Praveen, this is from Jennifer Hazelton. What are your thoughts on using Altman Z score to analyze supplier financials? You had briefly touched upon that. So
Yeah.
I think she's looking for how important it is. Is it make or break? Because it's a very, very fancied way to look at financial stability. A fancy ratio, that
Yeah,
is.
no, it's a benchmark which has been there, or rather a rule of thumb more than benchmark. It's a rule of thumb which has been there for almost 40 years now, right? And the relevance for each industry is not the same. So if you're using it for a manufacturing company, so Z-score is able to predict uh, a lot of problems in any company. It can predict bankruptcy, as it says, maybe not to a good extent, but it's a good rule of thumb. When you combine this with, say, a debt by equity for manufacturing company, then you see the correlation is almost 80-90%. So it's a very
That's
good
true.
rule of thumb. It should be applied only for manufacturing sectors. It doesn't work for services and different other new age industries where capital investment is less. There's not a big process which is involved because it depends on retained earnings, a lot of other factors which are important for a manufacturing firm versus others.
That's great. There's a comment from Lindsay Johnston. Just wanted to say that this was such an insightful and well presented webinar. So useful. Thank you. Thank you, Lindsay, for your kind comments. Next one, uh, it's again to do with DNB, Praveen. So how does DNB risk ratings work? What are the fees? Is it available for all countries? I believe we can access DNB even through our Verolive platform. So I think, Stephen, perhaps we will reach out to you to explain in detail how these things work, how it can be accessed through Vero platform. Thanks for that, team. Please make note of that query so that we can get back to him. So
Absolutely.
yeah, sure. So next one is from Etasham Bangash, Praveen. So he's asking, in current times of COVID, the risk of managing suppliers can really put the pressure on buyer, as well as keeping in view the effect on the cash flows. How do you manage the pressure? I think out he's saying how to get rid, but I think if I read it correctly, uh, is meaning how do you manage, how do you balance both, how do you both the cash flows as well as managing the supplier risk.
Uh, so, if it's relating to your own cash outlay versus the risk of a company, right? Then it's kind of a decision which happens at the category stage more than anything else. It's not a financial decision. It's more of a operational continuity decision. If you look at it from a different, the other angle of cash flow being important for your supplier and the risk which they are exposed to, absolutely. There's nothing more unadulterated in any financial statement than a cash flow or revenue, right? So these are the two unadulterated things. Because why I call this unadulterated is because accounting principles are not able to modify these two things to a great extent. You
Yeah.
can modify profitability, all of those different things, but the cash which is coming in from revenue, the cash which is going out to suppliers, that's where the cash flow statements become super critical and are fairly insightful. If that was a question.
Cash is king as always. It always reveals the truth.
Absolutely.
So again, okay, there's again a comment from Leticia Mungia on, again, when I meant again, it's again on DNB, relating to DNB. I find the DNB confusing. That is Dun& and Bradstreet. It would be great in future if you could offer a presentation how to understand these reports. Leticia, we have made note of your request. We will certainly get back to you. So we have about 3 minutes on the clock. So we'll take a couple of questions, Praveen. We have questions are flowing. In fact, I'm afraid we can't answer all of them. So quickly, Praveen, about risk management, what are the key points we should look or weigh in to take the final decision on choosing the ideal supplier? This is from Neil Brito.
Great question again. So uh, I think it's a comparison. It's not a standalone analysis which you should rely on for a particular company. One, it's against the industry, how well the supply is placed within that industry. We have seen cases where the financials of the company did not look good, right, on a say universal average basis. But when
Mm,
you looked at the industry averages, that was one of the best performing supplier in that industry. So this is a decision first based on that. Second, it is based on what options do you have, right? So if you have maybe five other companies you can work with, five other suppliers you can perhaps go in a contract with, compare them, one against the other. And
okay.
things like innovation, those are the things then become the differentiators. So all of them are in the same kind of risk bucket. Then you look at who's spending where, what their that exact profitability number is. Are they investing in innovation? Where are they planning to expand? Is that geography in where you are operating from, or you're planning to ramp up, is that also a focus area for that supplier? So these are the things I think which will become differentiators. Of course, the standalone analysis needs to be done before you can go to this step of comparing versus industry or versus other suppliers, other prospective suppliers.
That's great. So this is a very interesting question from Gisela De Leon. I think we should somehow take it up now. That the tool identifies, say, potential risk suppliers. So do you provide some action plan to improve the situation of the suppliers based on high, medium, or lower, lower level of the risk? So she is actually looking for, oh, do we also recommend corrective actions? So that's very interesting.
Yeah. So two ways maybe of, again, looking at this question. One uh, is that supplier critical enough where you can't survive without their services? So then it's a capital infusion which you as procurement will need to make, and so maybe advance payments in some cases. If it's not a capital infusion, just pay them for the next year so that they wait over that situation. That will only help companies which have a liquidity issue, and everything else is fine. Some event, some changes, restructuring might have happened. So that's the approach which I'll recommend for this kind of a situation. Second is the business continuity plan of it. So a supplier is not doing well. What are you doing to continue your supplier? So what is the BCP plan? Is there another site of that supplier? Can you make use of another supplier? Do you have the products from that second supplier tested, approved by your R&D for immediate implementation in your operations, right? So these, and of course, this BCP takes some time to develop, but if you see any problem with a supplier, asking for advance payments all the time, the second option I think you should develop in parallel while you help that supplier maintain supply till the time you have that luxury to diversify your procurement.
That's great. I think we have run out of time, but we will take one final question. Praveen, are you okay with that? Yeah,
Absolutely.
sure, sure. So this is from Didi Hansen. How do you measure risk with a company's sub tiers if you do not know where or who makes those parts? Basically, he's looking for a tier one, tier two, tier three. It's again a very
Yeah,
interesting question. Yeah.
yeah. We get this question a lot from fairly mature organizations where they've started to worry about risk in their supply chain versus the risk in their tier one suppliers, right? So you don't need to worry about financials of a company at tier two in a lot of cases, and you are able to pinpoint the problem just by looking at that category, right? So look at automobile today, and they're not able to operate. They had to shut down for their plants for like 3 to 6 months. The problem was semiconductor, correct? So in your supply chain, you can depend on the category itself. Figure out, is that category doing fine? A lot of market intelligence available on that. How's the supply doing, demand doing? Is there new demand which is coming up from another sector which can create a problem? So if you just analyze the commodity, the material, the subcomponent, I think you'll get fairly meaningful information on the financial of the tier, how it's going to behave going forward.
Okay. Thank you so much, Praveen. That was a very insightful session on how best to decode supplier finances. We have received several more interesting questions, but unfortunately, we have run out of time. I will try and reply by email to all the questions that were not answered in today's session. This marks the end of our session. A big thank you to all the participants for logging in today. And we'll be sharing the webinar recording link with all the participants soon. Many of you have asked for the recording link. Yes, we will be sharing it with you. Please do reach out to the email address on the screen if you have any additional questions, and we will try to answer them for you. Thank you and have a good day. And to all those in Asia, good night.
Thanks, everyone.
Thanks.